Hello, so let's talk about the learning objective 4. Learning objective 4 is, I would say, generalization of learning objective 1 to 3. So basically, we're looking at a more general case when you have one company manufacturing multiple products and how to find the break even and a target profit volumes. So the situation might be more complicated, but the idea is still very similar, and we have a lot of nice assumptions so that we can understand this break even and CVP from a relatively simple angle here. So let's take a look at what's happening here. So basically, let's assume that K sells a mix of a regular and a large posters in a 5-to-3 ratio. Okay, 5-to-3 ratio. So basically, let's assume that K always for every 5 regular posters K can sell, K will also sell 3 large posters. So there's a 5-to-3 ratio. For a large poster, sales price is $7 each, and the variable cost is $40 each. For a small poster, sales price is $35 each, and the variable cost is $21 each. Okay, so that's sort of idea here. So therefore, the question of how we can actually still apply the contribution margin and also everything here. In this case, we are going to introduce a so-called a weighted average contribution margin. Weighted average contribution margin. Okay, and how to do that? So the whole idea is we can take a look at, first of all, we are going to put them into one table to do some analysis here. So in this case, you can see that we have one column for regular posters, and we have one column for large posters. We have one column so-called a total in basket. So the idea is let's focus on each poster. So for regular posters, what do we have here is you start with the sales price per unit, $35, then minus variable cost per unit, which is $21. Then, and the regular posters column, we know that the contribution margin per unit is $14. Okay, and for large posters, we have a $70 sales price minus $40 variable cost per unit to arrive at $30 contribution margin per unit. Perfect. So now how we can blend those two posters to come up with a single contribution margin, okay, per unit or per basket, whatever you like to call that. So in this case, we are going to use this 5-to-3 ratio. So we have a so-called sales mix. So we have a 5 units for regular posters and 3 units for large posters. So we multiply $14 by 5 to find out the 5 regular poster contribution margin, and we multiply 30 by 3 to get $90. That's called $90 for 3 large posters. Then we add $70 to $90 to end up with $160 contribution margin in basket. So you can imagine that I have one basket consisting of 5 regular posters and 3 large posters. So in my basket, I have 8 units, 5 regular posters and 3 large posters according to their sales ratio. So the total contribution margin in that basket is $160, and I have 8 units. So the weighted average contribution margin per unit is dividing $160 by 8 units. So you end up with $20 per unit. So the weighted average contribution margin per unit is actually $20. It's not per regular poster, not per large poster. It's per actually a mix. So now we can address the issues: how many posters I need to sell and how many for each, how many of each product. So now let's actually come to the calculation part. So it's going to be a similar idea here. So the formula you can see that is fixed expenses plus operating income, right? Similar, same numerator divided by slightly modified denominator, which is a weighted average contribution margin per unit. In this case, let's assume that we still have the 7,000 fixed expenses plus operating income, which is 0 because we're looking at break even. So we have a 7,000 plus 0 divided by $20. So the result is 350 posters. In order to break even, then KL has to sell 350 posters of regular and large, which is a mix. But how many of each product, we're going to find out in the next step. So you may ask me, hey, how many I have for, how many regular posters I need to sell, how many large posters I need to sell. So what we have here is we can multiply 350 by the fraction now. So 5 out of 8 and 3 out of 8. So we multiply 350 by 5/8, multiply 350 by 3/8 to figure out the regular posters and the large posters in quantity. So in terms of the number of regular posters, we have 350 times 5/8, which is result is, I would say, about 219 regular posters. So for the large posters, I'm looking at 350 multiplied by 3/8, which is about 131 large posters. So that's about how you find the break-even units for multiple product firm. So now let's take a look at one specific example. Then we're going to apply what we have done in the prior question to this example to further understand this particular case. So it's going to be a similar, similar case is Crystal Cruise Line dataset, and assume that this company decides to offer two types of dinner cruises: regular cruises and executive cruises. The executive cruise includes complimentary cocktails and a 5-course dinner, which is a lot better on the upper deck. On the upper deck. Assume that fixed expenses remain at $210,000 per month, and that the following ticket prices and variable expenses apply. So this is a summary. And for regular cruise, we have a $50 sales price and $20 variable costs. And for executive cruise, we have $130 and $40. Let's assume that Crystal Cruise Line expects to sell 4 regular for every executive. So the sales ratio is 4:1. Compute the weighted average contribution margin per unit. Is it higher or lower than a simple average contribution margin? Why? Is it higher or lower than the regular contribution margin calculated in the prior question? We have that. And why this new sales mix caused Crystal Cruise Line break-even point to increase or decrease from what it was when it sold only regular cruises. So we are going to look at this question, and this is going to be a long question. It will take some time. So let's start the first issue here. Let's compute the weighted average contribution margin per unit. Alright, so the first thing we need to do is, we need to find the weighted average contribution margin per unit. So the idea is going to be similar. So we're going to set up one column for regular, one column for executive, and one column for total in basket. So let's review the regular one. So we have $50, that's sales price per ticket, and the variable cost per unit is $20. So therefore the contribution margin per regular ticket is $30. And the sales mix, as I said, is 4:1. So we have one basket. That basket consists of 5 tickets, 4 regular, 1 executive. So you multiply contribution margin per unit by 4 for regular to figure out the total contribution margin from the regular 4 tickets, which is 120. Then you do a very similar calculation for executive. You started with the $130 sales price minus $40 variable cost per unit to arrive at $90 contribution margin per unit. There is only one executive ticket in that basket, so therefore the total contribution margin from executive tickets is only $90. So together you have $120 from regular 4 tickets and $90 from one executive ticket. So together we have $210 contribution margin in this basket for 5 tickets. Then you divide the 210 by 5, you get 42. That's the contribution margin, weighted average contribution margin per unit, which is $42. Okay, so we just finished the first one. So next is remember what happened last time. If you look at what's happening here is compute the total number of dinner cruises that Crystal Cruise must sell to break even, and also compute the number of regular cruises and executive cruises the company must sell to break even. So we're going to actually deal with the break-even issues here. So first of all, we have to go back to the question to find out what is fixed expenses. Okay, it's about $210,000 per month. So we are going to use that number, and we have only break-even case here. So the operating income is absolutely zero here. So we're going to divide the 210,000 by the weighted average contribution margin. So we divide the 210,000 by $42, which is a weighted average contribution margin per unit. So it's a similar formula, and the result is 5,000 tickets. So in order to break even, we have to sell 5,000 tickets, which is a mix of regular and executive tickets. Then for the break-even sales of regular cruises, we have 5,000 times 4/5, because 4 out of 5 tickets are regular. So we multiply 5,000 by 4/5 to arrive at 4,000. And for executive cruises, we have 5,000 multiplied by 1/5. So 1 out of 5 tickets is executive. So that's how you multiply 5,000 by that. So therefore, 4,000 out of 5,000 tickets are regular, and 1,000 tickets out of 5,000 are executive. So together you still have 5,000 tickets. So we're done with that part. Now let's keep going, and there are more interesting examples you can take a look at. So maybe you may ask me, hey, how to deal with the other issues, how you answer other parts. So let me take a look at other parts that you wanted me to answer. So one of the questions in the problem is asking that is this number larger or smaller than if this company only sells regular tickets? If you go back to the learning objective 2, there is one slide talking about only regular tickets, and I remember that number is 7,000. If this company only sells regular tickets, then it must sell 7,000 in order to break even. But why now is 5,000? Why is actually less? Well, it's pretty easy to understand that, because executive tickets actually they have larger contribution margin per unit. So you don't need to sell that many anymore in order to break even. You can sell less to break even. So that's why instead of 7,000, now you only need to sell 5,000, because contribution margin per unit actually is larger in this case. So that's why you can sell less tickets to break even. So that's the reason here. So let's take a look at next interesting example. It's also a multi-product firm. So Danny Carter admired his wife's success at selling scarves at local craft shows. So he decided to make 2 types of plant stands to sell at the shows. The Danny makes twigger stands out of downed wood from his backyard and the yards of his neighbors. So his variable cost is minimum, wood screws and glue and so forth. However, Danny has to purchase wood to make his oak plant stands. His unit prices and costs are as follows. So there are 2 different kinds of stands. One is twigger stands, one is oak stands, and the sales price is $15 and $35 each respectively, and the variable cost per unit is $2.50 and $10 respectively. The twigger stands are more popular, so Danny sells 4 twigger stands for every 1 oak stand. So you can see there is actually a sales ratio which is 4:1. The Susie charges her husband $300. Well, this kind of interesting family business. $300 to share her booth at the craft shows. Well, to me that's fixed cost. After all, he has paid the entrance fees. Well, fair enough. How many of each plant stand does Danny need to sell to break even? Will this affect the number of scarves Susie needs to sell to break even? Then explain. So let's take a look at the first question, how many of each plant stand Danny needs to sell to break even. So to me the question is we need to find out what is a contribution margin, okay, per unit. Of course you cannot have a simple one. It's going to be a weighted average contribution margin per unit first. Then from there you're going to find how many stands you have to sell. Then you're going to use a sales ratio to figure out, okay, how many twigger stands, how many oak stands you need to sell. Okay, so that's sort of idea here. So now I'm going to find a contribution weighted average contribution margin for you guys. So if you look at the twigger and oak stands, and we have their sales information and variable cost information. So we start with the twigger first. $15 sales price and the $2.50 variable cost. So therefore that leaves us contribution margin per unit $12.50, and the sales ratio is 4:1. So one basket has 5 stands, 4 Twigger stands. I'm gonna multiply $12.50 by 4 units. So the result is $50 contribution margin. And then for the oak, we have a $35 sales price minus $10 variable cost per unit. To find the $25 contribution margin per unit, there's only one stand, so therefore we have $25 contribution margin. So together we have a $75 weighted average contribution margin, in total. Then per unit we divide that by 5 because there are 5 stands in my basket. So I divide 75 by 5 to get $15. So finally, weighted average contribution margin is $15. So now I'm gonna talk about how many units of each we have to sell in order to break even. So the formula is once again exactly the same: the fixed cost plus operating income divided by weighted average contribution margin per unit. So we have a $300 plus 0. That's fair because the husband Danny has to pay the Susie $300 to share the booth, and because it's break even, once again operating income is 0, then divided by weighted average contribution margin per unit, which is $15. So therefore you get 20 units. So then he has to sell 20 stands. Then the next is we're going to look at each. So how to find each stand? So we know that 4 out of 5 stands are Twigger, and 1 out of 5 is oak. So we multiply the 20 break-even units by each fraction. By 4/5 we get 16 units. By 1/5 we got 4 units. So then he has to sell 16 units of Twigger stands and 4 units of oak stands in order to break even. Now the next question is how that will affect Susie. So this is actually a funny question here. So it will actually change the break even for Susie. Why? Because if you go back to the question, the Danny actually pays $300 to share Susie's booth. So which means actually Susie has less fixed expenses. So let's assume that Susie actually has paid to the entrance fees of $1,300. So, but Susie is going to get $300 from her husband. So that means Susie has only 1,000 fixed expenses now instead of 1,300. So it's a lot of less. So in that case, actually Susie does not have to sell that many to break even after receiving $300 from her husband. It's going to be a lot of less because the fixed cost becomes less. Susie can sell less to break even now. So that's actually the answer to that question. So now we have finished this chapter entirely, and learning objective 5, we talk about a margin of safety, operating leverage, and most of the profit or cost structure. This learning objective is very interesting, very nice, and I'm going to leave that to you to read for fun, and it's very also very useful learning objective. And we are going to talk about this again in advanced cost accounting. So for accounting students, and keep that in mind, when we come to advanced cost accounting, we're going to touch the margin of safety, operating leverage again. So I hope you enjoyed this chapter. This chapter is so fun, so interesting, and I don't know how many of you guys have ever watched the Shark Tank. So a lot of questions actually from them about what is contribution margin and how to break even and how you're going to make break even happen, and what is a target operating income, and what is sales volume. So many questions from Shark Tanks. Those sharks actually are cost of volume profit analysis questions. So I hope you learn these questions very well, and one day when you have your own business, you can apply all these CVP analysis to improve your business, to make your business better. Okay, so enjoy this chapter, and I will talk to you next time.